I'm Devarsh. So first I'll take you through the key developments which has happened over the last fortnight. Then we will also review what has come into union budget. Then my colleague Gajendra will share his views from technical analysis perspective. After him, Siddharth will share his insights from derivatives. And in the end, we'll try to conclude. So let's start. So the global rally which started at the beginning of 2023 continues and the S&P 500 is now up by 8%. This week the US Fed increased the interest rates by 25 basis points. In India we had a sharp fall in Adani group related stocks and we also had the union budget. So let's first go through the key highlights of union budget. So on macroeconomic front, the Indian economy is expected to grow by 7% in 23. The size of the Indian economy is growing quite rapidly. From 9 years back, India was 10th largest economy. Now India is the 5th largest economy. The fiscal deficit for the 2023-24 has been kept at 5.9% and they are planning to bring it down to 4.5% by FY 25-26. The key highlight of the budget is that the government has decided to put about 10 lakh crore into capital expenditure and another 3.7 lakh in grant in aids. So total 13.7 lakh crore of total capital expenditure is going to be there in this budget. This is a very good news. This will help India's economy to grow quite faster in future. If we look at the maths behind the budget, it is quite credible. Government has assumed that the revenue received at a moderate 12.1% and they've also kept the subsidies lower. That means the numbers are achievable and they are quite credible. Now let's look at the various asset classes and key symbols and how they have performed over the last fortnight. So after touching 81 rupees, Indian rupee has depreciated by a rupee and now trading near 82. The Indian rupee has a resistance around 83 and we think that it is unlikely to breach in light of the recent developments. In US, as I mentioned, the rally which started in 2023 has almost gone up by 8% and the S&P 500 index has broken out of this downward sloping trend line. Emerging markets also had a rally. We think that after a brief correction, these markets are headed higher. Comparatively, from the fundamental perspective also, these markets are relatively cheap and they have better economic fundamentals ahead. European markets also continue to do well after the recent interest rate hike by ECB and Bank of England. There also the markets have digested those interest rates hike and markets like Germany's DAX have had a decent rally from 12,000 level back to now 15,500 kind of levels. Bitcoin also had a strong rally and now it is consolidating near 23,000 level, surged from 16,000 to 23,000 level over the last 1 month. Now let's look at the performance of various indices over the last 1 month. So Dow have had a 2% kind of rally, but Nasdaq had a huge 15% rally. Other markets also had a rally between 5 to 10%. Indian markets have comparatively corrected over the last 1 month. The outperformance which we had in the year 2022, now Indian markets are consolidating while other markets are catching up. Same is the case with our markets. They are more or less flat to negative for the last fortnight, while most of the markets have had a decent rally. Indian markets were plagued because of the issues related to Adani stocks and because of the carnage in those stocks, and they happen to be in the indices like Nifty. They have underperformed this fortnight. While we look at the sector, the oil and gas and power has been the worst performer. They are down quite drastically. Auto, FMCG and IT have been the outperformer sectors over the last fortnight. When we look at the economic calendar, the most important event is going to be on the 8th of February. The RBI's Monetary Policy Committee, MPC, they will pronounce their verdict on interest rates on 8th of February. So we expect RBI's MPC to follow the Fed and increase the interest rates. But like Fed, they will also give hints that we are at the fag end of the interest rate hike cycle. So these are the key developments which has happened over the last fortnight. Now let me hand it over to Gajendra to share his views from technical charts. Over to you, Gajendra.
Hello everyone, this is Gajendra Prabhu. I am presenting Fortnightly Technical Market Outlook. First, we look at Nifty daily. Index has strongly rebounded from 200 EMA. Index has breached the support of 17,400 and made the low of 17,353 on budget day due to volatility. Index has moved below 200 EMA and created a bear trap. Post budget, index recovered strongly and closed with positive note. Also, minor positive divergence has been witnessed in RSI. Immediate resistance is placed at 17,972, which is budget days high, but key resistance is placed at 18,070, which is downward sloping trend line. Above that, 18,200 to 18,300 would be the major resistance. Overall positive bias continue towards 18,070 and 18,200 to 18,300 band. The expected view would cancel out and fall below 17,550 or 17,500. On Nifty weekly chart, index has bounced back from 50-week EMA. Few months back, that is on 30th September 2022, index exactly found support at 50-week EMA and moved up sharply, registered a new life high of 18,887.60. Now, index repeating the same scenario. Will the history repeats? Let's wait and watch right now. Let's look at Sensex chart. It is outperforming Nifty. It is also not closed below 200 EMA and moved above budget days high. In addition, it is on the verge of breakout of downward sloping trend line. The current outperformance in Sensex is purely because of Adani group of stocks, not part of Sensex. However, technically, price development is strong. Immediate hurdle to form bullish dove formation is placed at 61,266 as it has formed a higher high on budget day. On weekly chart, Sensex has formed a classic piercing line candle formation at support zone, which is significant bullish reversal pattern. The 200-day story continues in Bank Nifty also. It is also moved below 200-day EMA, but did not closed below it. Same like others, and rebounded post budget. Few weeks back, Bank Nifty has provided a breakdown of triangle and its downside target also attained. On budget day, index exactly found resistance at lower trend line of the triangle. So strong resistance is placed around 42,050 levels. Overall momentum is positive. In the sector space, IT index is forming a higher tops and higher bottoms and continuing with the uptrend. If any dip comes, it would be a buying opportunity. Sometime back, index has formed a triple bottom and started to moving up from there. Now it is moving in a rising channel. Its outperformance would continue. Auto is another sector which is showing outperformance. Sustained higher top and higher bottoms has been witnessed. Importantly, it is approaching all-time high. It is just 1.3% away from its life high. Healthcare index remains in strong downtrend. Earlier, it has provided a breakdown of head and shoulder pattern. Only one thing is positive is it is deeply oversold. There is an intermarket divergence has been witnessed between Nifty with small cap index. Benchmark indices were made lower lows, while small cap index has maintained a higher low, which is positive divergence, and it is also a bullish reversal sign. Conclusion: Nifty has strongly rebounded from 200 AMA. Index has moved below 200 AMA and created a bear trap. However, post-budget index recovered strongly for two consecutive sessions and closed with strong note. RSI is placed with minor positive divergence. Key resistance is placed at 18,070, which is downward sloping trend line. Above that, 18,200 to 18,300 would be the major resistance, and medium term trend line trend reversal also. Further extended rise is likely once major resistance are surpassed. Overall positive bias could continue towards 18,070 and 18,200 to 18,300 band. And also make note, the expected view would cancel out on fall below 17,550 or 17,500 levels. Bank Nifty is bouncing back last two consecutive sessions. Positive momentum would continue. Resistance for the same is seen at 42,050. Support is seen at 40,400. IT and auto could continue their outperformance in coming days. That's all. Thank you.
Thank you, Gajendra. Now let's hear from Siddharth. Over to you, Siddharth.
This is Siddharth Deshpande from HDFC Securities. I will be covering derivative outlook today. This is a Nifty future chart of last 5 sessions where we can see higher volatility due to the budget announcement. We can see Nifty has closed 1.2% higher with a fall in open interest, suggesting a winding up short positions in the last week. Due to the budget announcement, there was a higher IB, but gradually it has come down and currently quoting at 14.6 level, which is suggesting a lower option premium for the coming weeks. PCR also has come down to the oversold territory. From that level, it has increased to 1.17, which is neither overbought or neither oversold ever. During that period, basis has also come down from 100 points to almost 46.2 points in the last week. We can see higher volatility also in the Bank Nifty, where Bank Nifty has rose by 2.4% with a fall in open interest, suggesting a covering of short positions. In that case, IB has also fallen from the 30 level to the 21.7 in the last week, whereas PCI has rose from the oversold region to the 1.05 level, which is neither overbought neither oversold region. Basis has also come down to 200 points from the 260 270 point high. This is a Nifty put call ratio chart where we can see at 17,500 to 17,700 where a maximum put writing has already happened, suggesting a support around that level in the near term. On the higher side, 18,000 and 18,200 has a maximum call writing, so suggesting a resistance around that level in the near term. Currently, Nifty is trading around 17,900. If in coming weeks, if Nifty is able to cross that 18,000 level, then trader can expect a Nifty heading towards 18,200 level. On the lower side, 17,700 has a good support. If it is breaching that support, then we can expect a 17,500 in the coming sessions. This is a Bank Nifty PCR chart where we can see at 42,000, 42,500 where the maximum call rating has already happened, suggesting a resistance on that level in the near term, whereas 41,500 and 41,000 has the maximum put rating, suggesting a resistance support around that level in the near term. Currently, Bank Nifty is trading around 41,600 level. This is FI long to short ratio in the index segment. We can see index was trading around 1.37 in the previous week, but it has fallen to the 0.2 to 0.3 level, which is very oversold level for the FI long to short ratio. This is point and figure Nifty future chart. We can see Nifty has already crossed that 45-degree line with by making a double top buy pattern, which is a bullish indication. So we can expect a Nifty heading towards 18,200 level. Same case is happening with the Nifty Bank Nifty also, where Bank Nifty has already crossed that 45-degree line by making double top buy pattern. We can expect a Bank Nifty will head towards 43,000 level in coming sessions. This is a heat map of last 1 week where we can see long build up in FHL, Indian Hotel, Chola Finance and Dalmia Bharat, where a short build up of observed in Hindustan, HDFC Live, Divi's Lab, Hindustan Copper, Whirlpool. Short covering was observed in Shri Cement, Ultratech Cement, IDFC First, Intellect, SBI Card, ICICI Bank and Navin Fluorine and Polycap. Whereas long unwinding was observed in Adani Enterprises, Adani Port, MFSL, Metropolis, Crompton Greaves and National Aluminium. Outlook for Nifty Bank Nifty and sectors for the next 1 week. Short covering was seen in Nifty future over the week with the highest call open interest near 18,000 level, suggesting a resistance around that level in the near term. Put writing was observed near 17,500 to 17,700 level, suggesting a support around that level in the near term. Whereas call writing was observed around 18,000 to 18,200 level, suggesting a resistance around that level in the near term. If Nifty able to breach that 18,000 level, then traders may see Nifty heading towards 18,200 level for the coming week. Outlook for the Bank Nifty. Short covering was observed in Bank Nifty too, whereas put writing was observed around 41,500 level, suggesting a support around that level in the near term, whereas call writing near 43,000 level, suggesting a resistance around that level in the near term. Bank Nifty was able to cross that 42,000, then we can see Bank Nifty is heading towards 42,500 level in the coming weeks. Sectorally, banks and IT stock may outperform the overall Nifty 50 in the coming week.
Thank you, Siddharth. Now let's try to conclude. So this week, Fed acknowledged that the disinflationary forces are taking shape, suggesting that they are making a progress in fight towards the inflation and end of the hike of the interest rate is near. If the situation on the employment front deteriorates, then only they will stop. Otherwise, we think that the interest rates are going to be hiked. So this means that the global markets are little ahead and then what they should be, and there should be some correction. But we don't think that they are going to give back all the recent gains. So we expect a little bit of consolidation in international markets over the next fortnight. In India, RBI will follow Fed and they will also increase the interest rates. Emerging markets are going to outperform the developed markets in 2023. We think that the fundamentals are quite good The central bankers of the emerging markets were ahead of the curve. They have increased the interest rates. The inflation problem is not so severe there, and that means these markets are likely to outperform as dollar has peaked out, and unless dollar continues to remain in this range near 102 to 106.7, we think emerging markets can continue to outperform. In Indian markets, in Nifty, it seems that there is a support near 17,400, 500 levels, and eventually we think that the markets will head towards 18,070 to 18,250 levels over the next fortnight. The mid cap and small cap have also had a correction, and now they are trading near the support. So we feel that over the next fortnight it is better to remain in the mid cap and small cap compared to the benchmark indices, where benchmark indices may consolidate and go a little bit higher, while Nifty, mid cap and small cap should start finding support and attempt a rally. That's all for this video. We hope you like this video and find the information provided useful. If you have any comments or suggestion, do reach out to us. Thank you.